Good evening. This is James Twomey, and this is the stock market report for July 26, 2022. A couple of things that we're going to go over tonight and just get some idea of where and what the market is doing. Tomorrow, the Fed will be announcing probably a 0.75 increase. So, as normal, those days you get a lot of fluctuation in the market, not necessarily indicated from hour to hour exactly how it's going to end up or proceed the next couple of days. So caution in trading. But just a couple of things. Newsflash. We're watching employment numbers and PMI. Decrease in hiring or layoffs will start indicating that the economy is cooled beyond just an inflationary headwind. Companies will pull in their horns. They'll start laying off people, and that will accelerate into recessionary area. Manufacturing index below 50, that's reported by the index, will show a contraction. That's probably the fourth shoe to drop. So you've got the inversion of the bond yields, which we've had a couple of times, and then more recently on the lower yield being higher than the shorter duration yields are higher than long term. So that has happened. It's happened a couple of times. In addition to that, we may see this week the second quarter with negative GDP growth or near zero. If it's negative, technically 2 quarters back-to-back GDP negative growth indicates technically a recession. However, the government is right now trying to redefine all that, and we're getting a lot of noise how that doesn't necessarily mean we're in recession, and how can we be in a recession with high unemployment. So this is the rocky boat that we're in right now. If employment stays where it is or just contracts a little bit, and they're saying, oh, we can handle 5%. What they're saying is, even though inflation's at 9% and probably higher in some of the areas, if it slows down, even if it knocks down a point or so, and people are working, they'll be able to afford this. That was kind of in the 70s, but we did have eventually layoffs there. But it's going to be interesting to watch. It's a slow roll right now. If we maintain good, solid employment and people are working, we can, unfortunately, it'll be a long stagflation probably period, but it's probably a lot better than a full-blown washout recession where people lose their jobs. Also this week, the Philadelphia Fed's manufacturing survey fell to minus 12.3. Now that's just one indicator. It's not the total PMI. They also had surveys for what the future was bringing. That was also negative. Last month was minus 3. The economists had expected that this recent survey by the Philadelphia Fed to actually show positive numbers, and it went from minus 3 to minus 12. So big shortfall there. It's telling things are slowing down. And now we're not totally out of this supply chain issue, but it's easing in certain products. You look at Walmart; they're having horrible numbers. They had to readjust their prognosis of earnings, and the last couple of days we've seen that as being a real negative. So all the Target and all those type of firms have all taken a big hit on the stock market. It helped started this downdraft we started seeing the other day. Basically, they probably, I'm making a guess here, but they probably ordered a bunch of stuff that didn't come in on the supply chain based on what they were ordering might be things that were more COVID-related shut-in type product, if you will. But also, too, and maybe now they're flooded with that, and people don't need that because they have other alternatives. They're not going to go out and buy a big screen TV or computers or whatever because they're busy enjoying the summer. The other thing that may be part of this, too, is they said that their food sector, so in other words, they're not selling as much. The baskets are smaller. The food pricing is eating away. The consumer is buying less. They're making adjustments. I don't have to tell you that. You're looking at even the rich people are feeling it. We're looking for high-tech firms to either indicate they're going to reduce hiring or not. We've certainly heard that in a couple of high-tech companies that they're reducing hirings. Keep an eye on that. Alphabet and Microsoft missed their earnings, but Microsoft is up tonight because they have positive outlook. So you know, the fundamentally on these companies, you really got to get under the hood, under their earnings. So we've got to see what is their headwinds. Was it something supply chain related, consumer related, in other words, inflation related, or are they overburdened with staff and they're going to have a hard time meeting numbers unless they do some, hey, it's a lot easier to get a few points down by laying people off. You can really reduce your balance sheet and make your profits better. So we're gonna keep your eyes open and we hope for the best. I've been digging into this, and actually somebody brought it to my attention. It's not really in the financial, but has known I was watching this. And the Fed quantitative tightening was supposed to begin in June. In theory, the Fed balance sheet, based on what they were planning on doing, should have shrunk by $47 billion in June. However, it only shrank 1.5. Now, part of this, some of the reports I'm reading, they're indicating they're not sure if there's an accounting lag. Let's face it, it's the government. IRS, post office, is anything efficient out there? They're working with the oldest technology in the world. I mean, it wouldn't surprise me. It's just, lag, and bad data, and summertime people aren't showing up for work. But with that said, if they're not reducing and they're not doing quantitative tightening, that's really could be a reason why the market's going up. I read another article that was coming off of some site. I'll have to look it up and bring it to our attention, because it was definitely based on government data, and that they actually bought $3 billion in bonds. So what's going on? I mean, is anybody at the helm over there? I hope in the meeting tomorrow that they grill Powell and they try to get a handle on this and see what's fact and what's fiction. Because if they are actually still buying and not reducing, the market's going to be manipulated. So that's, we need to know what's going on behind the scenes. More to come. All right, so buy alert. We've been stopped out of all our shorts. I've added back into the Qs and the Russell 2000. Not a lot. We'll go over the stocks in a very short minute right after this. They're all the long positions gave us the buy signal. I didn't say go out and buy. Many of you may have, using the Twomey investment process and the technical trading indicators that we use. And that's fine, because we did get a nice bounce. I'm just not ready because the Fed's still raising rates. We still haven't seen the full picture yet. My sense is we will not really come out of this is just a summer rally, a bear market rally. We're not going to come out of the woods until the Fed says, hey, we're going to hold off and tighten for a while. And then we can start believing the indicators. Now, again, that's my bias. And I've said before, if you trade on your bias, you're going to lose. So hopefully you're using the Twomey investment principles, and we're going to go over all those data, and we'll see where we go. TLT, I've been adding to that position that, again, defies all logic. Yields should be going up as inflation increases and the Fed raises. It's not happening. That's telling us that the people are believing 6 months out, whoever, when I say people, put that in quotation marks, it could be whoever is the stock market, let's call it, is predicting in 6 months where the Fed's not going to be raising rates or it's going to start backing down. Hard to believe when you're at 10% unemployment, 10% inflation, but time will tell. So very interesting. On the back of that, I said add to corporate and U.S. Treasury bond ETFs, because we'll be able to get out of them pretty quick. And we'll go through those numbers. We had SPTL, VCIT, one was corporate, one was the Treasuries, SPLB. I did go back into the short of the junk bond. I don't recommend it, but I'm playing kind of like what I call a mouse hunt, where the 120 kind of should go into it, but we don't know if it's going to do anything for us. All right, so dividend play, PAA. It's a mid-tier pipeline. That's it within Canada and U.S. They from the supplier to the user or the delivery station is the gas and oil. We'll go over that one as well. It's pretty steady straight. It's got a 9% dividend. Our other dividend play, Verizon, got blown out of the water the last couple of weeks. It did give us a sell signal. I did not personally sell it. I held it, figuring, I can, 5% is 5%, but then, went from 51 down to 40 whatever. So I'm still holding on that. Figure, we'll see where time goes, and I want to start going over some of these numbers before we'll come back to the sector trade. But let's go over the numbers real quick. TLT, that's the long of the 20-year Treasury bond ETF, if you will. And, what do we've got here? I'll make this a little bit bigger. We got the buy signal back here, back on June 30th, June 29th. It did confirm, I did indicate and let some people know buy. It got kind of tight here, but, it's been, we see our 9 EMA or 10 EMA, whichever one you use, is above the 14. And as long as it stay above, it's a buy. Right now, if you own it, you can put your first stop at 116.4 and the next third at 115.9 or 8, and then we wait for the third for a cross back. I've been adding on the dips, typical with my ETFs. I keep it. I wake up, if it's the other day, it was one trading at 116 point something before the market opened. I bought, and then it ended up at 118. If it's looks like it's going to end up, if it's opening down from the night before we're closed, I'm nibbling and adding to my position. Slow mover. I don't know, I don't expect this to really fly, but we'll see. I mean, right now we have to follow our indicators. The other one was the Vanguard Corporate, VCIT. Again, we're not going to make a ton of money. The dividend on this is like 2.2. It's a park. We're parking our money during this turbulent time. So we got the buy signal in around the same date. It was more in the early July, first week of July, around after July 4th. Same thing there, adding in a little bit on these down days. And we're going to maintain that. Your first stop would, now it's above the 50-day. Your first stop would be, first third would be at, right below the 9 EMA at 81, and then you put the next third at 80.7 maybe, and then you hold your third. So, these are slow rises. They're not parabolic, but it's a great place to park your money and you get a couple of percent dividend if you hold it for a while. What is it? SPTL is the Spider portfolio, long-term, a little bit longer-term bonds, a little bit of dip, but it's mostly treasuries, a little bit longer, not just a 20-year like the TLT. Same thing back on 7/1, and then same story here. And then you put, it's above the 50 now. You want to get your first third at 33.1, let's call it 33, and the next one at 33. So it's pretty tight stops for your first third and second third. And you can see there's been some draft days, add to it. Be careful. These things don't move fast, but it's bonds right now are defying logic. But again, if we trade by our bias, it's most likely going to be catastrophic at times. So we're going with our technicals here. We're using our buy signal. Let's get in. I believe we had. Do we have any others? Backspace. SPLB, price yield performance. Same deal on that one. That's 10-year market United Treasuries. PAA. Yes, this is a dividend fund. It's around 9%. It's a low volume. My feeling on low volume, you can get caught with your hands tied, because if you want to get out, maybe a big gap, you have to take a bath. But this one gave us the buy signal back on July 14th, 15th. It confirmed, got in, been adding in any chance I can. It's now above the 200 EMA. It's now above the 50 EMA. And actually, what's really positive here, the 50 just crossed above the 200. So what we're looking at here is a potential very flat type of investment. You look at this for the whole year and a half. It's been pretty flat since 2022. And what you're hoping for here is to really take advantage of your dividend, right? And watch that, get in that. XLU is another one that we're looking at. XLU. Um, it's just starting to cross. So you want to, if that does cross, keep your, and it's above the 50 and above the 200, you want to start jumping in there. Another, dividend type play. If bonds aren't attracting too many people, this may go up. So what you want to do is try XLU as another opportunity. The other thing is I just got into U.S. Steel. U.S. Steel just took off like crazy. It gave us a buy signal. This is a tricky one. It's low cost. It gets a lot of, I'll call it cult investors, and that's a wrong word, but it's appropriate. People will jump in, they look for a quick hit. It's low price. They'll buy a lot. But that's a buy, and I jumped in pretty heavy right when I got that. Um, so it's still room to play. It's flattening out here, and the relative strength index is 55. So you've got to be careful. Uh, the horse gets out of the barn pretty fast on this one. If you can get in on a pullback, that's great. Let's look at QQQ. We've got a few others, but let's look at our major index, right? This is still the relative strength index has come down about 50, and it was up around 57. It's starting to come down to close. It has broken its 14 EMA. It is definitely below the 50. In all extensive purposes, it's holding steady. We haven't got a sell signal. We did get the buy signal, and it's maintained it. It was flat for a little while, but I'm not recommending going long. If you do, just have your stops tight. This is a bear market rally. The inverse of that, the short of that, it's just above the 9, and it's eclipsing the 14 just about. It's being held back by the 50 EMA, and the relative strength index on that is 48. So they're pretty benign. The volume's picking up on that, but I've got a small position there. SPY, same story. All the indices are the same. The SPY, S&P, just starting to hit the below the 9 EMA. It's hitting the 14. It's definitely on the buy signal. The volume is low on the down days, so a pretty good indicator that it's summer work, and it looks like it's going to run. So buyer beware, right? Just if you do go long, because we have the buy signal, and it does make sense to do that, you just have to be cautious. And if you look at the inverse of that, nothing new there, right? Same as the others, and it hasn't given us anything near a buy signal. Let's go on. Our 120 has that. It's just starting to cross over positive, so I did go short today because of that, but on the thinking it might be a short mouse hunt, that we might get a little bit of a bump, but we'll see what the Fed and GDP numbers come out. So overall, there's some other things there to look at, but our sector table, this is based on the 20-day close: industrials, healthcare, information technology, utilities, real estate. So we're starting to see a much more, and energy still negative. You compare that to a 5-day. What's number one? Real estate. Interesting. Number one is energy, then real estate, and then utilities. Utilities definitely defensive. Healthcare definitely defensive. So on the 20-day. So what we're going to see is during the rally, not uncommon. We got some bumps in things like the industrials and the bigger cap companies, but you definitely saw our healthcare and utilities up there at the top, and to some extent real estate. I don't like to get too much into real estate unless it's a REIT, but with that said, obviously healthcare and utilities are very defensive, so nothing really earth-shattering. Financial still taking a beating. So, banks are looking, slow with the interest rates increasing. So nothing new there. I mean, again, it's some of those. I've been adding to shorts on up days. I'm not taking a big position. That's my bias. We don't have a buy signal at all. If you get the 120 that does cross into the buy territory, our quote unquote mouse hunt, fine. It's worth it, but keep your eyes on the market. Energy, and PAA. I was in UNG, U.S. Natural gas. I got stopped out. I made a tight stop because that you've heard my story about that. That's it fluctuates a lot, but we got the buy signal back on the 18th. I actually got in before that, and then I took a tight stop on that, and I got stopped out. And look at it; it's gone through the roof. I've been trying to get in for the last 4 or 5 days, and it just keep parabolic straight up. And now we're at the V shaped recovery, and we're now pretty much at the point of the last high. Not sure if we're going to be able to make it, but that's one that's kind of out of the barn. If we look at XLE, the kind of the basket of utilities, ETFs for big oil, gas, and the service sector, that hasn't given us the buy signal. It's kind of hanging around there. I've got a low bid in there. It's being repelled by the 50, and it's being upheld by the 9 and the 14 EMA. So it's a little range bound here. I'm not ready to jump into the oil sector just yet. And I did have I did short oil, but that I took my profits and I haven't gone back in that either. So, you know, I look at the gas pump; it's coming down a little bit. The release of the strategic reserves has helped out a little bit. The demand crunch has helped out a little bit. So a lot of good things going on there to keep prices a little bit lower. So I'm not ready to go that. I think these gaps on the upper side. Let's go through the SPY actually the QQQs really show it the best. What do I mean by gaps? If you're looking at this is the long position daily chart, right? There's um, oops, let's get a little bit smaller. These gaps, this is where it gapped down these 2 days in a row on the downdraft. Well, we definitely, they say gaps should be filled, and when that price moves from a big gap low to high, you don't have the competition of people trying to sell, so it's almost a pure buy. So we filled that first gap, and we filled the second gap, and we started getting near the highs again, and sure enough, we're being range bound there. So we're filling those gaps. We predicted they would be filled. We're not in the prediction business, but you should be, it makes sense. All right, advanced decline. That's another thing you want to keep an eye on. This is the bigger macro picture. What I really like about this but I still didn't go long, was the advances and decline are holding above the 50 EMA. Look at that. It's like almost the longest since April. So, whoops, hey, come back here. And, pretty good sign. The relative straight index is up at 56, so it's climbed quite higher. 70 is our overbought. And look at our MACD is way up. So a lot of positive there. That's, we're now somewhere in the low 70s or mid 70s for stocks in the New York Stock Exchange that are below the 200. So a little bit of improvement there. That's kind of a macro view to tell you where things are. The longer it stays above the 50, the more positive it is for it to go long. We've gone over our support levels. We haven't hit those yet. We've talked about the duration of average bear market. I'm really surprised. There's a lot of rhetoric out there. I don't know if it's because it's the slow roll or they're looking at the Ukraine war and the supply and the COVID issues, shut down in China. But if you look globally, Europe's in a mess and they're really hurting with this energy sector problem. Russia's putting the squeeze on them by, we're fixing, the Nord Stream and some other things, but now we can't get parts because, the sanctions, on and on and on. It's a game. It is a chess game. And right now, Putin is putting the screws to Europe, and Europe is really going to be in a mess pretty soon. And then we're shipping all kinds of natural gas over there. I don't have the numbers. I did look at them. I wanted to put it in this report. And if you look at this, that's our natural gas is going up. It's the highest it's been since 2008, maybe. I don't know, but it's a long time. And we're shipping it out. So again, this is what happens. Countries get, and people get under the gun. They try to lower their currency and then make their products cheaper so people will buy their products. They try to, lower their numbers and buy their way out of the recession by saying, hey, buy our products. Our dollar's cheaper. Well, Europe and US are on par, just one for one, right? So, we're looking at this and saying, Europe's going down in a spiral as well. They're trying to attract US dollars. And they're certainly going to, get it. If energy runs this way for a long time, even if it comes down a little bit here in the U.S., this is going to be a debacle come winter. So we'll see. It's too early to tell. I'm not saying buy energy now. I'm just talking about the economy slowing down worldwide. It's really exasperating. So we need to keep an eye on all this, and hopefully we'll get through it by having high employment. Uh, Legends of bear markets. This is worth beginning of bear market rallies are flashy. They're short lived. The market grinds lower. The rallies tend to grow bigger, and they get exciting and can be deceptive. Well, I think we're in one now. Financial crises. We had some very positive 8, 12, 7%, and then before new lows came in. We're not out of the woods yet. So let's keep our eyes open. If you want to play some of those longs, using our technical indicators that say buy long, please do, but be careful. Have a tight stop. If you get stopped in and out, it's a trade. That's all it is. I think we've parked our money now into some of these bond plays. Good place to hide your money, get some interest. We've got some dividend plays. Verizon has hurt us a little bit, but I think that will come back. You can certainly add a little bit if it stays flat here at the lows, and we'll take it from there. It did give us, some people did sell out of it with the sell signal, but it is a risk, and I did decide to keep it. So we'll see, and more to come. I'm going to eventually get this all onto a website so you can go on demand, get the video, get the training, have all the parameters, how to set up your stock trading table, the Twomey investment process. So there'll be training videos that you can pull up on demand, and you could start building your desk, and you could start making some of these decisions. We'll have some forums, but we're ways out from that right now, and I think that'll be a better avenue than having just YouTube alerts out there. If you like what you see, let your friends know, hit the like button, and certainly, subscribe, and you'll get the alerts. Nice chatting with you. Have a great day, and we'll talk to you soon. Bye now.